I think everybody actually wants a weaker dollar. Scott Bessent's talked about it. The Chinese desperately need it so they don't have to devalue the yuan against the dollar. As you've said, they don't want to do that. The Japanese would probably quite like it. The Europeans would like it. The Canadians, the Aussies. I mean, everybody wants a weaker dollar, and the US wants one. And then China is free to stimulate. As you said, it needs to do a gigantic debasement of its own currency, of its monetization of its debt. I feel like there's a game to be played here, and the outcome is the Chinese can stimulate, which was 2017 cycle was no US liquidity. It was all China.
Okay, well, I think we're, as far as I can see, the liquidity cycle is still expanding. I think the issue that we've really got is how much further can it keep going up? Because there are certain clear challenges. And I think the two challenges that really sort of concern me, I suppose, number one is the US. And that really comes back to, I think, two particular dimensions. I mean, one is what the Federal Reserve has been doing, which is this sort of what I've termed sort of secretive or not QE stimulus. And that's kind of fading. And they're going to have to go more explicitly to a sort of a formal QE, although I note that Canada also has done that, but it refused to call it QE. So they said they're restarting balance sheet expansion, but it's, of course, not QE. Of course, they would say that, wouldn't they? And the other issue then for the US is the Treasury, where Janet's been doing this sort of very clever funding trick by funding at the short end, where, you kind of look at the math of that, and it's basically meant that the Treasury has managed to stick in the equivalent in liquidity terms of about $6 trillion of additional stimulus by changing that funding dynamic. Now, that's a huge amount, and that's clearly running off fast, particularly if Scott Bessent is intent on moving back to coupon issuance. So I think you've got those two questions, which are really pertinent ones, and they'll really hinge on what the new administration sort of thinks and says. The other issue, which is maybe gives us near-term concern but long-term salvation, is China, where China is currently seeing extreme debt deflation, where the PBOC has taken a whopping amount of liquidity out of the markets in the last 4 to 6 weeks, trying to hold the yuan up against the rising dollar. And they badly need to monetize big time. Well, I would put the figure of sort of 30% monetization. So China's got to print money big time. America needs to do that, not to the same extent. So we're in a long-term monetary inflation, there's no question, but I'm just pausing because I think there may be a little bit of an air pocket now.
Okay, lots to pick apart from there. So the first thing I'm thinking is obviously we've, breaking down liquidity, the reverse repo is almost drained now, and that'll be drained soonish, which probably suggests an end of QT, because you can see bond market liquidity is not great. And you can see that around the world. There's just not enough liquidity in the system. The gilts market's been a mess, stuff like that. So it feels that they're going to have to end QT as soon as the reverse repo drops. Yellen's made it pretty clear that, even though it's Scott's job now, she's going to have to draw down the TGA until they agree something on the debt ceiling. So that, I guess, is a net liquidity injection that's coming from that. How do you measure this shorter term funding dynamic? And what does that show up as stimulus? Because that's not something that most people are capturing. I read your stuff, and I know you've been talking about it a lot, and it makes sense, but does it get captured elsewhere? Or do you have to just look at bill issuance in its own right and add that to liquidity measures?
You mean you're talking about the funding, how she's changed funding?
That's right, the very short-term debt.
Well, what I've done, there's actually a slide in a pack I sent you, which is actually slide 25, which you can slide into the tool. But basically what that shows is my estimates of what I call not QE, which is what Jay Powell does, and which is the TGA and things like the rundown of the reverse repos. And you've also got on top of that the other bit that I've called not yield curve control, which is unconventional funding. And that is something like about together, they're adding something like about 6 trillion to stimulus. Now, the way that I've done that is to look at a concept called dollar duration and to look at how dollar duration has changed and put that in liquidity equivalent terms. So that's how I estimate it. And that's really against a normal funding benchmark. The skew has been quite noticeable because as you understand, I mean, treasuryable finance has gone up hugely. Bills have been a large proportion of what's funded the deficit in the last 12 months. And on top of that, Janet's skewed the issuance calendar away from long-dated coupons towards shorter-dated ones. And she's taken about a year and a quarter on average out of the average, treasury auction.
Does that change the debt refi cycle? Or does this just get mopped up in this kind of final year of the debt refi cycle, the 4-year cycle? Or have they restructured it where we're going to end up with, as opposed to a 4-year average cycle, we end up with a 2.5-year cycle?
Well, that could be the case, couldn't it? It could be short cycles are shortened, and they're going to have to, they're going to have to start pushing a lot more liquidity back more immediately. I mean, that may be the issue. I mean, we know that Scott Bessent's got to fund 30% of the deficit 30% of the outstanding debt this year.
Yeah, and so even if he moves out further duration, the market won't take it without liquidity. Whether it's some form of QE. I think you're rightly suggesting nobody wants to use the word QE anymore because it's a dirty word. So they just find any other way of hiding it.
Yeah, exactly. And I think this is the reality, because if they don't add liquidity, who's going to buy this debt, this coupon debt? And we know the structure of the treasury market is itself quite fragile because, foreigners are not really buying American debt anymore in the size they were. A lot of it's coming down to hedge funds. Those hedge funds, and as you will remember, they're fairly fickle, or certainly short term. They want to earn a profit. And as the yield curve is steepening, the cost of hedging is going up the whole time. So often, as you will recall, you see breaks in markets where suddenly people just bail out. And that's the problem the treasury market could face, a spike up in yields. I mean, we're doing pretty well at the moment, aren't we? I mean, yields have moved up quite smartly anyway.
My view on this, I like to test the hypothesis, is I think everybody actually wants a weaker dollar. Scott Bessent's talked about it. The Chinese desperately need it so they don't have to devalue the yuan against the dollar. As you've said, they don't want to do that. The Japanese would probably quite like it. The Europeans would like it. The Canadians, the Aussies. I mean, everybody wants a weaker dollar, and the US wants one. But it's fantastic negotiating policy because it's the most powerful throat grip you can possibly have. And so it feels that you get China to play ball in whatever mechanism you've got. And in exchange, you add dollar liquidity into the global system and allow the dollar to weaken. Whether it's, I think the TJ's part of it, but my guess is whether it's swap lines elsewhere, whatever, just to get it into the euro-dollar banking system. And then China is free to stimulate. As you said, it needs to do a gigantic debasement of its own currency, of its monetization of its debt as stimulus. It needs to do that, but it can't do it without losing control of the yuan for the time being. So if the US will give them cover, kind of what happened last time Trump came in 2017. Right. So I feel like there's a game to be played here, and the outcome is the Chinese can stimulate, which was 2017 cycle was no US liquidity. It was all China.
Yeah, I think that's exactly right. And that was also, in a different guise, what happened in the Plaza Accord in 1995. And that was a very similar deal where the US eased initially, got the dollar down, and then everybody else joined in on the side pumping liquidity. And that sort of led up to the 87 crash ultimately, or the Louvre Accord and the 87 crash. But that was the path. So I think that I've got a lot of sympathy with that. I think that's right. I think the dollar is key. I mean, I agree with you. I think that they need a strong dollar now because it's a great negotiating tool. A longer term, I don't know, but I would suspect they would prefer a firmer dollar than a very weak dollar. But the rest of the world desperately needs a weaker dollar because they're being strangled at the moment. The dollar wrecking ball is definitely swinging. Make no mistake, look at the problems in Europe right now.
Yeah, I mean, the dollar is cyclical. So on a secular basis, because 50% of the world's debts are in dollars, it's going higher because there's always a shortage of dollars. So we get that. Every time liquidity comes out of the system, the dollar goes up.
Yeah.
But at this point in the business cycle, with the ISM survey still low, China in recession, Europe in recession, essentially, they all have to stimulate because in the end, if China picks up, they buy more treasuries.
Yeah.
Yeah. There's the whole financing game, the state of nations that goes on here as well.
Yeah, I think that's right. I mean, I think that there needs to be a deal generally, and that's a US-China deal. And what shape that takes, whether it's focused exclusively on trade or whether it involves some buying of treasuries, I don't know what. But they definitely need to square those circles. And I think, an easy win for Scott Bessent would be to say, get the Europeans, the Japanese, and the Saudis to buy more American treasuries as defense bonds. I mean, I think that's a pretty straightforward thing to do. But how China deals with that, I don't know.
Oh, that's interesting. So Trump's idea of you should be paying for your defense becomes a more direct purchase of treasuries. That's a very interesting idea. And it's very simple. It's very clean.
Yeah.
But I guess a lot of them need to say, well, we need world trade to pick up because we're not earning enough dollars to buy the treasuries, which again is down to the dollar needs to weaken argument. So world trade can pick up.
Yeah, absolutely. I mean, and the other thing is, there's going to be talk right now the Japanese are tightening, but in reality, they can't tighten very much. I mean, this is ludicrous. I mean, their debt problems are so big and their economy is pretty weak as well. So, okay, they may make a token gesture, but they can't. They need a bailout as well. So the only solution, as you rightly say, is some sort of US easing. And that may well involve or likely involve some peaking of the dollar.
And, just so people watching this understand why we're talking about all of these is because the dollar is the dominant driver of global liquidity because global liquidity is priced in dollars essentially, right?
Well, I think it's certainly a key factor, yeah. For the reason that a lot of lending, as you rightly say, is dollar-based, so that's key. And then if you look at how central banks run their policies, a lot of them are actually focused on the exchange rates anyway. So if you start to see a very strong dollar, you may well get tightening in offshore economies to try and protect their currencies. Whereas if the dollar is very weak, there's a degree of freedom where people can go along and print money at the same time. So you get a generalized easing. So there's a very asymmetric response in the dollar that a weaker dollar is unambiguously good, whereas a strong dollar.
Welcome back to the Market Chronicles, everybody. Episode number 9, and we are diving deep into global finance today. If you're at all interested in what's shaping the world economy, this is going to be a good one. And for our YouTube viewers, don't forget to hit that subscribe button so you don't miss any future deep dives. We're looking at some comments today from Raoul Pal. Pretty well-known macro investor, right?
Yeah, he had a really interesting conversation with another expert, and they were unpacking all the connections between the U.S. dollar and Chinese economic policies, global liquidity, that kind of thing.
Yeah, the dollar is kind of a big deal.
Huge. I mean, one of the things that Pal was talking about was how a strong dollar, it really restricts global liquidity.
Makes sense. I mean, when the dollar gets stronger, it makes it way more expensive for other countries to service their debts.
Exactly. Especially when you think about how much global lending is actually happening in U.S. dollars. It's a lot. So any shift in the dollar.
Yeah, you see central banks everywhere reacting to it.
Oh, yeah, constantly. They're either tightening or easing policy based on what the dollar is doing. It's this constant back and forth.
So then you bring China into the mix, and they've got their own set of challenges, right?
Absolutely. They need to stimulate their economy.
Which usually means
Easing monetary easing, printing money. But they're also really worried about the yuan weakening too much against the dollar.
Yeah, it's a tough spot to be in.
It is. Like walking a tightrope, too much easing. And yeah, the yuan weakens. You could see capital flight, inflation, all sorts of problems. But if they don't ease enough,
The recovery could stall out.
exactly. And this is where Powell's idea of an air pocket comes in. He thinks there's a real risk of a liquidity crunch coming.
Because of.
Well, he points to a couple things, the Fed, obviously, but also what the Treasury's doing, how they're managing the U.S. debt. It's fascinating.
He uses some pretty interesting terms, too. Not QE.
Right, not yield curve control. Yield curve control. Basically what he's saying is that the Treasury is being sneaky. They're finding ways to inject liquidity without it looking like QE or yield curve control.
So how are they doing that?
Think of it this way. They're playing around with the maturity structure of the debt. They issue more short-term debt, which floods the market with cash in the short run.
Yeah?
But down the line, when that debt matures, they'll need to roll it over, and that's where things could get tricky.
So it's a temporary fix?
Seems like it. Which might mean that the U.S. is going to have to actually ease monetary policy at some point to really support the global economy. I mean, let's face it, a weaker dollar would help a lot of countries out.
China, Japan, Europe, all those guys carrying a lot of dollar-denominated debt?
It would give them breathing room, let them stimulate their own economies more aggressively.
And that's where Powell's theory about a U.S.-China game comes into play.
Right. He thinks the U.S. might be using the strong dollar as leverage to get concessions from China.
Like what?
Could be anything, increased purchases of U.S. treasuries, maybe more cooperation on trade, who knows? But the U.S. has the upper hand here.
It's like a high-stakes negotiation.
Exactly. And it reminds me a bit of the Plaza Accord back in 1985. That was when they agreed to weaken the dollar, and it led to a big wave of global easing.
History doesn't always repeat itself, but
It often rhymes. Oh, and get this, Pal even suggested this idea of defense bonds. Basically, the U.S. would encourage its allies, Europe, Japan, Saudi Arabia, to buy more U.S. treasuries.
framed as what? Like a contribution to global security.
Exactly. It's a pretty wild idea when you think about it.
It would be a way for the U.S. to finance its military spending, but also prop up demand for U.S. debt.
And of course, a weaker dollar would make it easier for those countries to buy in.
Yeah, but would they actually go for it? That's a big question.
Right. What would it mean for the dollar as the world's reserve currency? There are a lot of unknowns.
It's a risky move, for sure, but it shows you how much power the U.S. has with the dollar.
Oh, yeah. But it's not all sunshine and roses. The strong dollar, it's putting a strain on the global economy.
For sure. And Powell and this other expert, they were pointing to some pretty clear signs that this liquidity squeeze is already happening.
Yeah, they talked about the reverse repo market drying up.
Which basically means
It's where financial institutions park their excess cash overnight, and when that market shrinks, it's a sign that liquidity is tightening up.
and they also talked about the bond market, like how strained liquidity is there.
Which can have a big impact on borrowing costs for governments and corporations.
It seems like the Treasury's game plan of pumping trillions of dollars into the system through short-term debt, it's hitting a wall.
Yeah, and you have to consider who's actually holding all this U.S. debt now. It used to be foreign investors, but now
Hedge funds.
a lot of it, which is kind of worrying because hedge funds, they're notorious for their short-term outlook.
They could pull out at any moment.
Exactly. It just adds another layer of volatility to the whole thing.
So what's the bottom line here? I mean, the dollar, it's creating winners and losers.
Definitely. And it's pushing these economic superpowers like the U.S. and China into this weird game of chicken.
Nobody wants to blink first.
And understanding all of this is so important if you're trying to make sense of what's happening in the world of finance and investment.
This is the stuff that really matters. Yeah, it really makes you think, doesn't it, about how fragile everything is.
It does. And that's what I love about these conversations. They force you to look beyond the surface.
To really dig into what's driving the global economy.
Yeah. You know, one thing that Pal said that really stuck with me was this idea that we're moving away from easy money.
Like we're at the end of an era.
Almost. The era of not QE, all those unconventional tricks.
It's got to end sometime, right?
It does, and that has huge implications for investors. I mean, we've all gotten used to low interest rates, tons of liquidity in the system.
What happens when that changes?
That's the question, isn't it? Asset prices, investment strategies, everything gets reevaluated.
It's like we've been playing with a safety net.
And somebody just cut the ropes.
Yeah, that's a good way to put it.
It makes you realize how important diversification is, risk management, all that stuff. It's going to be a lot more volatile out there.
For sure. We can't just assume that the past is going to predict the future.
No way! The rules of the game are changing all the time.
And as Pal was saying, a dollar, it's at the center of all of this.
It is. It doesn't matter if it weakens like he thinks it will, or if it stays strong. It's going to have a huge impact on everyone.
The dollar is the one thing that connects all these economic and geopolitical problems we're facing.
It really is. So to everyone listening, as you're out there navigating the world of finance and investing, remember what we talked about today.
Don't just follow the herd.
Don't chase the hot trends.
Understand the fundamentals.
That's how you make smart decisions.
That's how you survive in this crazy global financial system. Thanks for joining us on this deep dive.
It's been fun.
Until next time, keep learning, keep exploring, and keep questioning everything.